Welcome to Market Movers. I'm Jim Urio with Scott and Martin.
Hi, Jim.
Okay, so we heard from the Fed today. So prior to today, the market was saying the Fed's a little bit dovish. The Fed was saying, no, really, we're neutral. Today they sounded dovish. He talks about inflation. He talked about letting it run. Who's right?
Well, who's right now, I believe, Jim, is the Fed, because the market seems to be taking that stance a little bit better, let's say, than it has been in the past. With respect to letting inflation run, I think that's the right message, because if you look around just outside of our central bank, Jim, inflation is nowhere.
Okay, here's the big question. On Friday, we saw a relatively blockbuster NFP number. Why isn't the Fed hawkish? Is there something hanging over their head?
Well, there's the fact that we have still a lot of downward pressure on interest rates around the globe. We still have a trade deal that is or is not happening. And generally speaking, yes, the data is getting better. Blockbuster was a word you used. It's still not very inflationary considering historicals.
I agree. I think it's a trade deal. Yeah. Now, before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. When we price these out, the 10-year was trading about 129.10. Scott?
Yeah, a little volatility in the ZN today, Jim, just given the fact it's Fed day. I think that's typical. But like I said, there's not a whole lot to see here today with respect to what the Fed's doing, which is a good thing, my friend. And something, though, that I found interesting in the charts that I'm going to tell you about in a second, if you just wait a minute, about how I think there's a way to kind of express yourself, seeing that maybe there may not be a lot of movement, let's say, by the end of the year. So specifically, Jim, looking today at an example of buying the week 1 January 129, 128.5 put spread for 14 ticks. This trade expires January 3rd. It mentioned the underlying in the ZN. I'm going to pay for this, though, Jim, by selling a week 1 130 call in the ZN, Jim, for, you guessed it, 14 ticks. So therefore, my outlay is zero. This trade risks me getting short ZN, let's say at 130, with a potential reward of 500 if that put spread fills out. Just because I do believe that given that the Fed is on a good track here, rates will generally trend up, but I don't believe they're going to go crazy.
No, I agree with the direction. I like if they say they're going to let inflation run, a normal logical progression is that the curve should steepen out, rates should go higher.
Great point. And you mentioned growth trends too, being out there, which should push up rates as well.
As long as you're willing to accept that risk of being short at 130, then it's a fine trade. This is not going to surprise you much either. The direction I agree with, and my trade is a lot more conservative. And that's consistently been the case for you and I. And that's
sometimes they both work.
Right, I'm perfectly comfortable with that. So as an example, I'm buying the week 1 Jan, the same expiration, January 3rd, the 128.5, 128, 127 and 3/4 put fly for 6 ticks. Now that's buying the 128.5, 128 put spread, so that's a 50 tick wide put spread, and then selling the quarter tick wide put spread, the 128, 127 and 3/4 put spread, and all that for 6 ticks. So it risks 93 to make a potential 406. The reason I do these uneven put spreads, because it's one thing to pick it in the middle and try to maximize your put spread, but sometimes it blows through. And in this case, you still make money because it's 50 and 25.
Agreed. And the reason that when it blows through, you don't have to thread the needle as much on, say, some of your expressions, which I like. And also the fact, too, if you look at those levels, those are consistent levels, I believe, in the charts as well, that point out where there is that support resistance in the ZN that I think they're worth expressing.
Quick question. With the Fed either relatively dovish or neutral, the domestic data good, and the China story still hanging out there, is it almost the perfect situation for risk assets because they kind of have to stay dovish pending a resolution?
I believe it is. And historically speaking, if you look at Fed behavior, Jim, the market's risk assets, let's say, tend to do best when the Fed is neither tightening nor cutting, but stable with interest rate policy.
Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.